There's a question here on the screen. Harper Company's performance report indicated the following information for the past month. Actual total overhead 1,600,000. Budgeted fixed overhead is 1,500,000. Applied fixed overhead at the rate of $3 per labor hour 1,200,000. Applied variable overhead at $0.50 per labor hour, it's 200,000. Apart from that, we also have the information about the actual labor hours, which is 430 hours. 430,000 hours. And then Harper's total overhead spending variance for the month was. So we are asked to calculate what is total overhead spending variance. So let's solve this question. So we have the data given here, and the formula for the overhead spending variance is the difference between the budgeted overheads and the actual overheads. Now, from the data what we have, we see that budgeted overheads we have the budgeted overheads minus the actual overheads. Actual overheads, the data is already provided to us, which is 1,600,000. So this is there. About the budgeted overheads is the sum total. Now we are asked to calculate about the total overhead spending variance. So the total overheads have to be taken into consideration. So total overheads will be the sum total of the budgeted fixed overheads and the budgeted variable overheads. So when we add both of them, it would become the total overheads. So total budgeted overheads minus the total actual overheads. So actual total overheads are already given to us. We need to now find out about the budgeted total overheads. Now, how do we calculate this one? Now, the data has multiple variables. Here we have budgeted fixed overhead, which is 1,500,000. So, fixed overhead would remain the same within the relevant range for any activity level. See, the amount of fixed overhead which is decided is 1,500,000. Now, this was decided at some activity level. So, when from this information, we understand that if the fixed overheads were applied at the rate of $3 per labor hour and it comes out to be 1,200, so it means to say that the total number of hours are 400,000. 1,200,000 divided by 3 gives us 400,000. The same can be understood even from here as well. See, we see that applied variable overheads is at the rate of 0.50 per labor hour. So, at the rate of 0.5, if it is calculated, and the cost, if it is 200,000, it should be 400,000 hours. So the budgeted hours are decided at 400,000. So from this data, we understand that it is 400,000. But the actual activity happened at a different activity level. The actual activity is at 430,000 hours. So now fixed overhead, whether it is at 400,000 hours or 430,000 hours, it would still be the same. 1,500,000 would still be the same because fixed overhead does not vary within the relevant range. Apart from that, the budgeted variable overhead has now to be calculated because variable cost is a cost which varies proportionately with the level of activity. So, accordingly, we write the amounts here. If it is the budgeted fixed overhead, it would be the same 1,500,000 plus about the variable overheads. See, variable overhead rate is calculated at the rate of 0.50 per hour into, but now the actual activity is 430,000 hours. So multiply it into 430,000. So this calculation will help us to understand what is the total budgeted total overheads. Done. Minus actual overheads is 1,600,000. Okay. So here we have this one as 1,500,000 plus 215. So this gives us 1,715,000 minus 1,600,000. we see that the actual overheads are less than the budgeted overheads by 115,000. When the actual cost is less than the budgeted cost, we call such a variance as a favorable variance. Okay. So now that is the answer. So the answer here is about B, which is 115,000 favorable. I hope that is clear.